welcome to this channel. A goal of mine is to have this channel be a resource for entrepreneurs and business owners on their journeys. Would you like to introduce yourself for us?
Okay, thank you for having me. My name is Desmond Bredu. I'm the head of client services for Stanbic Investments. Beyond that, I also have an aim, just like you, to help people manage their money as well. So I usually speak to young people about managing their finances, about investment, about savings, basically to help them build wealth for their future. So that's what basically I do, maybe through TV or through some maybe conferences as well. Yeah, so that's what I do.
Okay, great. So today you'll be helping us understand the basic of financial management. So we'd like to start with the basic investment terms. As a small business owner, what are some basic investment terms you should be aware of?
Okay. I think maybe the very first one is what your assets are, or simply put, the things that you own. So let's say you are, a farmer.
Yes.
You own a cutlass, you own a hoe, you own a cultivator. Those are the things that you own, that belongs to you. Then look at the other side, the things that you owe, your liabilities.
Okay.
Maybe you've taken a loan from somebody.
Yeah.
So that is things you owe other people, that's liabilities.
So walk us through the basics. Okay. Assets and liabilities. What are assets and what are liabilities?
So like I said, so assets are basically the things that are for you, the things that you own as a business or as a business owner. So let's say you are a farmer, you have, let's say, a cutlass that belongs to you, you have a cultivator that belongs to you. So those are the things that belong to you. If you're talking about liabilities, things that you owe or your obligations. Say, for example, you took a loan to set up your business. So that's things you owe. So that's your liabilities bit. Now, when it comes to income, those are the monies that flow to your business from your operating activities. So maybe when you sell your produce, the things that you get, or the money that you get, those are your income. Now, when you talk about expense, things that you spend on, let's say probably you're employing other people that you need to pay them, maybe some part of salaries, maybe you are renting a place to store your produce.
Yes.
So maybe you pay rent, utilities. So those are the things that basically every business owner needs to know.
Or if you outsource some of the things that you do. For example, you get people to come and
do by day for you.
Yeah, by day or pluck out the weeds.
Exactly.
Those are not part of employed staff, but they're outsourced. So that would also be
an expense for you.
Right.
Yeah. So basically, those are the things you need to know. Then beyond that, how do you prepare maybe your statement? And basically you have profit and loss. In old terms, profit and loss.
Yeah.
Basically showing you what, for a given year, your actual status in terms of your profit, or whether you've made a loss. So maybe, let's say, for example, in a given year, you sold items worth 100 cedis. You spent 80 cedis in getting 100 cedis. So your net profit for that period is 20 cedis, and that's what the profit and loss basically is about. Then we have statement of financial position, or what we used to call balance sheet, showing your assets and also liabilities at a given point in time. So that basically
that usually happens at the end of every year. The end of every year.
Yes.
All right.
But the thing is, I mean, accounting is flexible such that not everyone starts their business, say, January to December. So you can have, let's say, July to June.
Yeah.
So depending on when you end your statement, you can. It doesn't have to be calendar.
You can follow any structure you give to it.
Yes.
Okay.
But usually it's December and June.
Okay.
That's where.
So what are some of the goals that, for example, small business owners and entrepreneurs should set for themselves, financial goals?
So maybe as a business, let me talk about the business first. Maybe your first goal is that what emergency fund do you have? So let's say I'm going to start business, but I don't know what will happen in the next few months or the next few years. So let me put something aside. That's the goal, that I have an emergency fund, or I start building an emergency fund for myself, such that if no more income is coming in
from
the business, I'll still be able to operate at an optimal level going forward. So I think that's the very first goal that you need to do for yourself. Then the second thing, or the second goal every business needs to have, is the plan to innovate, or to, let's say, I don't know how to put it, if this is where my business is, this is where I want to take it to, and this is how I plan to get it to. So, and one key thing is innovation, Because I always say that there's usually no new business in the system, but it's how you stand out, how you innovate to stand out, and that will make you thrive.
Yes.
So for me, that's every goal that every business needs to have. Then beyond that, the financial projections. This is where I am in terms of my revenue. I'm earning, let's say in a given year, I'm earning 10,000 Ghana cedis. Maybe in the next year, I want to earn 12,000. I want to earn 15,000. So probably prepare your statement or your cash flow showing where you want to get to at the end of maybe every given period. And that's, I think, some basic things. In terms of personal finances,
Yes.
you can look at, say, okay, can I plan for my retirement?
Yes.
Because, again, you can't work forever.
So that's a dicey subject. I mean, we've seen how hard it is to live on retirement income.
Yeah.
One. We've also seen how troubling it is to work for most of your life and then not be able to
get something,
live comfortably off your retirement fund.
Yeah.
So, with that said, what structures can you put in place for yourself so that you can retire? But before I ask, what do you think the optimal retirement age is?
So, per legal requirement, it's supposed to be 60.
No, we're not talking legal requirements. Personal. Okay, let's make it more personal. What age would you like to retire?
So for me, I want to retire at 50.
At 50, okay.
Now, for me, everybody's retirement, you should envisage the kind of retirement you want.
Yes.
So, and everybody has the idea of, I want to retire early. But we don't have to necessarily wait for that age. You can incorporate some retirement goals in your daily living or in your usual living. Let's say you want to retire at 50 before you focus on your gardening or your travel. You can be doing maybe one bit at a time whilst you wait to retire. But for me, I want to retire at 60. But if it doesn't happen, that's fine. But how do I get there? That's the most important thing for me.
Okay.
Yeah.
So one thing that you have to do that's imperative is to start planning for your retirement
from
the very day you start business or you start earning an income.
One city. So you get your first one city, you start thinking about retirement.
So now you've told us the what.
Yeah.
Can you tell us the how? How do you do it?
Awesome. So we are talking about entrepreneurs here. So usually
or small businesses.
Small businesses. Yeah. So usually for these people, they don't have a stable income coming in. So for me, what I always say is the very basic thing is for you to prepare what you call a lean or a bare bones budget. So you plan with your worst case scenario. So if, let's say, you can always say, okay, let me look at the past 6 months. What was my least income I made? So let's say if maybe it was 1,000 cedis, what can I plan with the 1,000 cedis with, such that I have enough or something to save up for that retirement I'm looking at? Like I mentioned, the income is not straightforward. Sometimes in a given month, maybe you can get 10,000, maybe some get 5,000, maybe some months you get nothing at all. So that's the very first point, having a budget that you can work with.
And your budget must be consistent no matter the type of income that's coming in.
So I'm saying that the basic is the bare bones, where if not for anything, this is how much you've gotten or you would get worst case scenario. That's what you plan with. So if more comes, then you can, then what adjustments can I make? Can I maybe look at expanding? Can I look at, let's say, increasing my investment? Can I look at increasing my emergency fund? But all of these things would have been taken care of already in your bare bones.
Yes.
But if more is coming in, then you can look at saying, okay, how can I review my budget? And that's what's important for you if you want to plan for your business and as well as your own retirement as well.
So what's the difference between a retirement fund and an investment fund?
So you can use your investment fund to plan for your retirement.
Yes.
But again, for entrepreneurs, most of them don't work the salaried worker where they have the SNET. But even that, you can also contribute as an entrepreneur to these master trust schemes where you join maybe one of these big ones. So you contribute every month, and at the end of let's say you retire at 50 or 60, they pay you whatever you've contributed with any accrued interest that you've gotten. For investment accounts, those are something that you can do on your own, and there are various investment options that are available for you. But again, because usually most entrepreneurs don't have so much funds, we recommend that you look at unit trust and mutual funds, usually the fixed income ones, which are more long-term in nature.
Wait. Now explain those things to us.
Okay.
talk to me like you're talking to a 5-year-old.
Okay.
Unit trust and
mutual
mutual
funds.
funds. Can you break it down?
Yeah. So so let me just break
I'm
it
a
down.
5-year-old.
Let me break it down.
Okay.
So if I gave you 50 cedis
Yes.
to go to any bank to
Yes.
invest, most likely than not, they'll tell you to put in a savings account.
Yes.
Because that money is small, right? Now, but at the same time, we want people to invest. We want people to get decent returns. Now, that is where unit trust and mutual funds come in.
Yes.
Now, instead of you going on your own, why don't you partner with somebody or a group of people who then bring their monies together, give it to the professional to manage for them? And that's where unit trust and mutual funds come in. So, for example, now instead of you having one person with 50 Ghana cedis, we have 10,000 people with 50 Ghana cedis. Now that we can 500,000 Ghana cedis. With the same money, if you go to the same bank, we'll get a better interest.
You get a better return on your investment
Than if you went on your own.
Yes.
So that's the concept between of the unit trust and mutual funds, where people come together, investors come together, give their money to a fund manager. They manage their fund on their behalf.
So hold on. Investors here could mean the broad sense of anybody. It could
Anybody.
be your friend, your family.
Anybody.
I mean, even
You don't even have to know that other people.
if you can just get a group of, for example, area boys together, 20 or 30, put your monies together.
Not necessarily that.
Okay.
Not necessarily. So each unit trust and mutual has to be registered.
Yes.
So there's a registered schemes that are available.
Exactly.
I was just talking about the fact that there is a collection of people who have given their money to a professional to manage for them.
Yeah.
So it doesn't. It can be just you just going to just join the group that you don't know
that
about.
has already been set up.
Exactly.
Yes.
So then there are some that are existent that are registered by the SEC.
That has to be registered by the
It has to, because otherwise, for someone who just take your money and run away, so it has to be
It's
registered.
problematic.
Yes, it has to be registered. So you come in, and the good thing is, regardless of the amount you bring in, each of you are getting the same percentage returns. So, like I mentioned, if you have 50 Ghana cedis and you went to a bank, they tell you to put in an investment account, in a savings account.
Yes.
But last year, for instance, you can get mutual funds and unit trusts averaging 16%, 15%, which is sometimes better than the treasury bill.
Yeah.
So that's something that you as an entrepreneur can benefit from. You can even use that. In fact, let me even give you an example. I have friends who are entrepreneurs who use this unit trust to manage their business. Now, there are some of them that are very liquid, in that you're able to...
Hold on.
Liquid.
Again, we have 5 years. Liquid. What does that mean?
In that you can easily get your money back.
Yes.
Sometimes within 24 hours, 48 hours. So, for example, let me give you an example. You are a small business owner. You have to, let's say, buy some goods for your firm or for your business, but your money is in a money market. I'll explain that. A money market unit trust. It's structured such that it's easy for you to access it. So instead of you keeping your money in a bank account where you're getting almost 0 or 1% interest, you can keep it in an investment account, which is getting you 15, 16%, at the same time giving the opportunity to be able to withdraw or access it at any time.
Yes.
So at the same time, you're eating your cake and having it.
Yes. So liquid means easily accessible.
Easily accessible.
Okay.
Exactly.
Okay.
Now, I was coming to the unit trust bit. As I was saying, it's easily, many people can join at any time. And like I mentioned, there are a couple of them that are available. Like I mentioned, money market.
Yeah.
That which, just to simply break it down, is basically short-term investment.
Yeah.
When I say short-term, usually 3 months, 6 months. Even for some of them, it can be 1 week. You can just put your money in and just withdraw it the following week. You get me? So that is there. Then we have fixed income, which is usually long-term, in simple terms, long-term. Then we have equity type, which are more into buying of shares.
Yeah. So
if that's what you want to do, you can look at that. But for a business owner, it's not really recommended you put your money in an equity fund because shares are volatile. So maybe you want to buy an equipment and you've put your money in an equity fund. Maybe in the next 3 months, the value of equities will go down. So the money that you've invested has even reduced. So that won't help you achieve your goals. So for mostly, it's recommended for business owners to do the short term, that's the money market types, or the fixed income types.
Okay.
Yeah.
All right. So a key financial goal for entrepreneurs and business owners: start financial planning early.
Yes.
And start retirement planning early.
And also the building their emergency fund. And that's why I said you can use the unit trust and mutual funds to do that. instead of keeping it in a bank account sitting somewhere,
Yes.
put it in an investment account. And the unit trust offers you the opportunity to do that at the same time, getting very good returns and access to your money as well. So yes.
Okay. So, in my advice, when I onboard small clients or entrepreneurs, one key principle I let them know is to automate their savings.
Perfect.
That way, you don't feel the pinch of what you're doing.
Yeah.
Can you speak on saving automation, or instead of investment automation, rather?
So, first, let me just, people misconstrue or like interchange savings and investment.
Okay.
So let me just probably try and explain those two.
Yes.
Now, when you talk about savings,
Yes.
I use a big term here, but savings is simply deferred consumption or delayed gratification.
Yeah.
So what I mean is,
of practicing delayed gratification.
yeah. So if let's say I have 100 CDs, okay, and I keep it in a shoebox or under my bed,
yes,
and I don't spend it today, and I'm leaving it for next week, I have saved.
Good.
So that's basically what savings is. But let's ask yourself, the 100 CDs that you're having today, can you buy the same thing a week from now, a month from now, a year from now? No. So what do you need to do? You save to invest.
Yeah.
So the investment is therefore buying assets or securities. When I say assets or securities, the investment I mentioned, treasury bills, bonds, we can define all of those things. But basically, buying things which will give you a return
on your
money.
On your money.
On your money. And that's what basically investment basically is about. So it's advisable to save to invest, not just to save, because inflation will just eat your money away. So it's advisable that you invest. Now, speaking on the fact that you have to automate your savings, usually what I tell people is you need to pay yourself first. And that's what automation of your savings starts for you.
Break it down. Pay yourself first. What does that mean?
If you get your income as a business and you are paying rent, you are paying, let's say, utility, what you are effectively doing is you've become an income redistribution center. Let me break it down. You've gotten the income, you've redistributed it. You're paying your landlord for the rent. You're paying the people you've hired. You're paying the suppliers. What are you paying yourself? And that's what I say, that pay yourself first. Take a portion of the money and give it to you as your reward for your hard work. Pay your future, what's something your future self will thank you for. Because if you don't do that, like I said, you become an income redistribution center. You get the income, then you redistribute. What are you paying yourself with?
But the thing is, most entrepreneurs or small business owners have this fear of financial literacy.
Yeah.
So that forces them to pay themselves last instead of paying themselves first. Because they're thinking that, without me, the business cannot continue.
Yeah.
I made the business get to the point that it is. So let me pay everybody else first.
No.
And then what I have, I can save for later use.
The principle is paying yourself a fair amount or a fair wage. If, for example, your business worth or does on average an income of 1,000 CDs, and you want to pay yourself 700 CDs first, because Desmond says pay yourself first, it's not a fair wage based on your business.
And it's also not practical.
It's not practical.
Yes.
So, now, like I said, and that's why I mentioned the bare bones budgeting first. Once you're able to do that initial stage of knowing what worst case scenario you'll be able to save up, that's what you're using to pay yourself first. So if, let's say, it's 1,000 CDs that you're getting a month, and you can comfortably and consistently save 50 or 60 or 100 Ghana CDs for yourself, that is your payment to yourself first.
Okay.
But ideally, it is recommended that you pay yourself 20% of whatever you're making. 20%. But it's not cast in stone. For some business, it's very difficult to be able to do that 20%. Consistently. And that's the key thing for me. People start and they stop alongside. And it doesn't help anybody. If I know that I can do 10% consistently, it's recommended you do that. Because you'll be able to be consistent with it. And once you build that attitude, once you get more, you can then increase it as you go along. So that's something that everybody can probably look along in that particular sense. But yes, I agree with you when it comes to automating the savings or your investment, but it's really crucial.
Okay.
But if you don't do that, you end up, everything you come in, you just spread it across, spread across.
So first thing, you automate savings and then automate investment.
Again, it's together.
You
save to invest.
Save to invest.
Yes.
Okay.
Yeah.
So that requires a mindset shift.
Yeah.
Not only thinking one-dimensional from thinking about saving. but thinking about saving to invest or
Yes.
saving with having investment goals in mind.
Yes. Again, just on your last point, the investment goals, like I mentioned, maybe it's like you're saving for your retirement. You can even save for vacation, save for your children's education. You can even save for your own property. So depending on the goal that you have, you can look at how much I need to save up to be able to achieve those kind of goals that you set for yourself personally. Yes.
Okay.
Yeah.
Well, that is fantastic.
Yeah.
So you explained the unit trust and
mutual funds.
Are there any other types of investments?
Yes, the other types of investment, like simply, what most people are familiar with is the treasury bills, where simply you're lending the money to the government. But you see, in the context of...
Wait, before that, treasury bills, are they high risk or low risk?
Low risk.
Low risk.
Usually, even when you're doing finance, you're right, we even term it as risk-free.
Okay.
In the terms of worst case scenario, the government can print money to pay you.
Yes.
So we use a proxy for risk-free investment. Yes. So so basically that's the
again,
list.
the reason why I'm asking you these questions is I am trying to create financial literacy for small business.
Yeah.
Although you and I might understand the terms.
Yeah.
I want you to explain it to us because I found out that in the financial world they use the most complex jargon to describe the simplest of things.
Yes. Yeah.
So a risk-free investment is
worst case scenario, you are getting your money back.
Yes.
Yeah.
And the higher the risk,
they had an expected return.
Okay.
So let me just explain that. Many people have the notion that they had a risk, they had a return, supposing that the return is guaranteed. No, nothing is guaranteed in this life. So we say that they had a risk. When we say risk, the propensity that what you are investing in will not materialize like how you want it to.
Yes.
And that's what basically risk is.
Like what you went to bed dreaming about. All the figures and dollar signs in your mind.
Yes. So they had a risk, they had expected return. So let me just make an example. If I'm giving money to a government, where I know that worst case scenario, they're able to print money and pay me back. If I'm giving to you as an individual, then obviously you are more riskier than the government because you can't go and print money and pay me back.
Yes.
So that is you being a little riskier than the government. So what will happen is, if I'm giving the same money, I would expect that you give me a better return than the government. So that's why I say expected return. It's not guaranteed because again you can run away with my money. And again you can run away with my money as well. So that is where they had a risk, they had an expected return. But the reason again on the treasury bills that we don't, I don't usually recommend for entrepreneurs is, usually treasury bills are for let's say 3 months, 6 months, right? For most often than not,
for set periods.
Set periods.
Yes.
And in this business that you do, sometimes you might need take advantage of some quick opportunities.
Yes.
If you go and want to liquidate in terms of withdraw or break your investment,
your money. Yes.
Usually there's charges on those things
yes.
involved. So it's not really recommended. I mean, you can have it for your own personal stuff, but for your business, it's sometimes not recommended because of the charges. And sometimes, if you want to break it, now you have to notify them. You have to get someone to sell it to and all those things. So it becomes a bit difficult. So it's a good investment, but if you want to use it to manage your business, like an emergency fund, I don't think that's the best for you.
Okay.
Yeah.
So walk us through other low risk investment options apart from treasury bills.
So you can do, again, those are other forms of investment, but may not necessarily help you as a business.
Okay.
So for me, what I always say is, the most important thing is, why are you investing? In the context of what goal do you have? Yeah. So if, for example, the goal is to have, let's say, to be able to put up a structure for your business, that's long term. So you can look at a treasury bill, that's fine, because you can always roll over to get, when I say roll over, you can always continue to reinvest the money to get to that point in time. But if it is for emergency fund, then it's not the best option.
Okay.
You understand? So other investment opportunities are, let's say, a fixed deposit.
Is that also categorized as low risk or high risk?
No, it's usually medium.
Medium, okay.
But the thing is, it could also be high risk as well.
Okay, so let's start. We've done low, so let's go
medium and high.
Okay, so medium is
like a fixed deposit.
Yes.
Like a fixed deposit.
Explain that to us.
So, for example, you can walk into any bank or non-bank financial institution, like the savings and loans companies, all those things, and you say that, okay, I have 100 Ghana cedis or 1,000 Ghana cedis. I want to give it to you for 6 months, so a fixed term. So at the end of the period, at the end of the 6 months, pay me, say, 10% on the money. And that's what basically fixed deposit is. You give your money to an institution for a defined period, and they'll apply an interest rate on it and give your money back to you at the end of the period. Now, I mentioned that it could be medium risk or high risk.
Yes.
If I give my money to, let's say, a grade A bank, it's probably medium risk, because maybe it's very tough for them to go defunct or for them to probably go down. But if I go and give it to a microfinance in my area, that's high risk, because it's the same fixed deposit, but they are likely to suffer more if there's any government regulation or anything than maybe a grade A bank. So the same fixed deposit, but it could be medium risk. At the same time, it could also be a high risk investment, depending on where you put it. So for me, but the thing is, I recommend you put it in a bank than the microfinance.
Yes.
But the thing is, the banks won't give you any decent return. The microfinance will give you a good return because of the higher risk.
Yes.
Yes. But for me, I always say that put your money, focus on safety than higher sustainable returns.
Okay.
Safety for me is paramount.
Yeah.
You go to bed knowing that the following day you can wake up and go and meet your money intact.
Not even meet your money. You go and meet the bank in the same place you left it.
Exactly. So
There's times in which banks go bankrupt.
Yeah.
They stop trading.
yeah.
I mean, several years back, I don't know if you heard of the Lehman Brothers, the bank.
Yeah.
They went bankrupt. Nobody expected
them to
such a bank to go bust, but it happened.
It happens.
So yes,
Even in Ghana, some banks
some banks have shut down, which was very problematic and troubling at the same time. Okay.
So imagine a microfinance somewhere that it will be tough, much tougher for them. So basically, again, there are other forms of investment, like shares, for example, or equity. That's basically a unit ownership in a company. So you can buy stocks or shares or equity, how you want to term it or where you're coming from. So, but the thing is, shares are highly volatile.
So
what I mean volatile?
Would you classify that as high risk?
High risk.
Yes.
When I say volatile, what I mean is the price
fluctuate.
can fluctuate.
Yes.
So today, the price can be 1 cedi, the following day it can be 70 pesos, it can go to 80 pesos. But the good thing is, the SEC and the GSC, when I mean GSC, I mean the Ghana Stock Exchange,
And the SEC.
Security and Exchange Commission,
Yes.
they've put in measures to curtail
Those are the regulatory bodies.
exactly, to reduce the volatility
Yes.
in that. On the shares, like I mentioned, it's basically a unit ownership in a company. And some people call it stocks or equity as well.
Yes.
Yeah, so you can buy it on the Ghana Stock Exchange through a licensed broker. And these brokers are usually banks as well. So when you walk into any bank, you tell them that, okay, do you have a brokerage firm that I can buy shares through?
Yes.
But the thing is, you need to know is, shares are volatile. When I mean volatile is that it fluctuates, in that the price can go up or down periodically. It could even be daily. So that is where you need to watch. So maybe, like I mentioned, your goal that you have for your business might not be suitable if you want to go and buy shares. Like for example, you want to buy equipment.
Yes.
Or you want to buy something for your business in the next 3 months.
A computer.
A computer for your business. And you go and put your money in the Ghana Stock Exchange. And in 3 months' time, the price of shares go down. You'll not be able to meet your business need. Or let's say you have salaries you want to pay. By keeping your salaries in a stock account, and the stock price keeps going down, you don't have enough money to pay the salaries. So, again, the goals that you have for your business or for yourself should determine what you should put your money in. So like we've mentioned about unit trust, about treasury bills, about fixed deposits, about shares or equity now.
So shares are high risk.
High risk.
For people, for example, people like me who want to live life on the
long
wild side.
term, long term as well. You can have.
I'm here for a good time. I'm not here for a long time. Stuff like that. Okay. All right. So, in terms of financial literacy, what are some of the basics in separating your business expenses with your personal expenses?
That is a tough thing for most businesses, if you're being real. It's recommended that you separate your business account from your personal account.
So what are the everyday practices?
So simply put, you can just have a separate Momo Now, when I say mobile money for
Yes.
a business, now most of these telcos have made it easy to register. Once you have your certificate of business or incorporation, you're able to register a separate business line.
So create a different identity
for your
distinct
business.
from your business.
From business.
Even if you can start with separating your mobile money
Transactions.
Yes.
Simply put. Now you can look at the next step. Can I get a business account? Instead of your regular bank account that you deal with, where probably all your monies, anything on the comes in. Let me have a separate business account, such that if someone is paying me, pay it into my business account. So what does that do for me? It will help me know that how much money is coming in. If I have any expense to pay, I'll pay for my business account. I won't mix my business with my personal. So maybe from the basic, and again, mobile money is not accessible to almost everybody. So you
And
can
even
start
apart from that, I like the fact that you brought in mobile money, because then you can integrate it into electronic transactions.
Exactly.
It can be on your website.
Exactly.
So you can receive payment even internationally through mobile money.
Exactly.
Now, so when you have that, it runs separately from your
personal,
business. Yes.
personal thing. Yes, and again, it's so crucial because I mean, even yesterday I was having a chat with a friend of mine. She's into selling paintings, but she was telling me this one. It's so tough trying to decipher or to put what's my business money, what's my personal money. And I asked her, your problem is simple. Just get a separate business Momo account.
Get a separate account, and to piggyback off what you said earlier, pay yourself first.
Pay yourself first.
With those two things in mind.
So let's say, for example, at the end of the month,
yes,
you're able to track your money. So I made X amount. I spent X amount. I made 100 CDs. I spent 80 CDs. What I have is 20 CDs. How much can I pay myself from this amount? Then you move that money from your business account into your personal account. Whatever you do with that, it's not a business concern. And the good thing is, with more money now, you can even link it to your bank account. So
yes,
you can link your business account to your mobile money. So if someone pays you through mobile money, you can still transfer it to your business account. Keeping records becomes easier for you.
yes.
Yeah.
So keep a business account separate.
Separate.
Keep your mobile money
Separate.
wallets separate.
And pay yourself.
And pay yourself.
Yeah.
Okay. Are these all? There's something else you need
I
to
think
bear in mind?
that's the basics.
Those
If
are
you want
the
to be able to manage your business finances separate from, and one thing I always say is, once you in quote eat into the money you've invested, you need to account for it.
Yes.
And that's what we call, let's say, your drawings or the money you've taken out of your business. Because if, for example, your salary you're paying yourself is 100 CDs, but in a given month you are going out and you spend 20 CDs on Uber from your business account, you need to take that money from your 100 CDs.
Yeah.
Not from the extra that is in your business.
So it requires a lot of self-discipline to keep you from dipping your hand back into the business job all the time.
Yeah. And now the good thing is, now you don't have to stress yourself doing all of these things. There are even Excel sheets that can help you. In fact, I did one webinar like that, and I just gave them an Excel sheet. Whatever you need to just input Momo 5 CDs, or let's say Uber 10 CDs. At the end of the month, the Excel sheet gives you your income statement. You don't have to stress it. Well, if you want a professional, you can get someone to help you with your finances, your business finances. But it becomes so easy for you to be able to put an Excel sheet together. Then
so at least that gives you a broad overview of your business growth or the trajectory of your business. At the end of every year, you can sit down and have a yearly review of how your business went.
Exactly.
And based on that income statement, you can also project where you want your business to go to.
Yeah.
Or where you need to put more funds
into. You even need that to even source some loans. Some financial institutions require you to have financial records.
Yes.
And if you have these
most financial institutions. Don't make it sound sweet. Most.
So if you want to expand, and sometimes it's funny. You say, "Oh, bring your last 3 years record." You don't have any.
But then now you have to start cooking up.
Yes. But if you have this simple Excel sheet here and there, you can get someone who's professional. The person will put everything together and get you a statement. Easy peasy. Then you can get to source your loan like that. Yeah.
Wow, fantastic.
Yeah.
So key is separating personal
finances
from business finances.
Okay. Yeah. Maybe another thing probably we should look at is how, cash is the lifeblood of most businesses.
Yeah.
So maybe cash flow in terms of what money is coming in and what money is going out. For a business, right, it's advisable that we see something like extend your payables. If you want to manage your business well, what do I mean by payables? The people you owe. If, let's say, you're going to buy, let's say, a particular equipment, and they're giving you 60 days to pay up, that is free money for you. Wait till the 59th day or 60th day before you pay. So what that will happen is you can use that money that you have expensed to be input in your business till the time is due for you to pay that expense. On the other hand, shorten your receivables.
Yeah.
So if you can give discounts for people to pay early, use that to people to pay early. So that once you have the money, the cash is king. You can reinvest the money into your business. But if you extend your receivable, you've sold something to somebody.
So breaking it down in a much simpler way.
Yeah.
Cash in hand today is better than cash promised tomorrow.
Exactly.
So if, for example, you send out an invoice as an entrepreneur or a business owner for, let's say, 5,000 USD.
Yeah.
And the person says, today I can pay you 4K.
Yeah, take it.
Your advice would be take it.
Take it. And I mean, unless the discount is too steep.
Yes.
Then you can probably do a payment term. I guess, okay, I'll take the 4K, then the 1K will spread it. Or if the person tells you, okay, no, I'd rather wait 2 weeks time and pay you the 5K. No, take the 4K and spread the 1K over the 2 weeks instead. At least you have something that you can be working with in your business.
And that is essential advice because we all saw what happened with the pandemic.
Yeah.
And how it puts
everything
a hold on businesses and payments and everything. So I think that is great advice.
Yeah.
Because with the pandemic, there was all sorts of uncertainty.
Yeah.
Nobody knew what was happening.
Yes.
Nobody was paying invoices. Contracts were being cancelled here and there. Hospitality industries shut down. So that is very good advice. And one thing that you also said that I love is separate your business expenses.
Yeah.
So even with that, if you create different bank accounts, personal bank, business bank account, and to make it simple, what I would recommend is you have 2 different institutions.
Okay.
That reduces the likelihood of you transferring business funds into your personal funds.
Yeah.
And when you do, you have different ATM cards.
ATM cards. Yeah.
So you keep them separate. If you know you're the indisciplined type, leave the ATM card at the office. The business ATM card at the office. Keep your personal ones.
Yeah.
So that you're not always in a hurry to dip into it. Because what people start thinking is, and this is company law 101, once you register a business or an entity, it's separate from your daily activities.
Yeah.
It has its own life.
Identity.
So you need to treat it as such and respect it as such. Keep it separate. When it comes to business and then finances. The indiscipline comes about where you think that I started a business.
Yeah.
So it's my business. And I as well do as I please. Once I'm broke, and
it's
then
mine.
it's mine anyway. So then you can easily dip into it.
Yeah.
But one key thing, and that you've mentioned, that goes into all of this is forming the habits of financial discipline and discipline.
Yes. And I mean, I was happy you touched on the expenses part when talking about your business expenses. And just to extend that further, in my interactions with many small businesses, right, I realized that they don't, and this is where I always see, they only focus on revenue, not net profit. And net profit, revenue is the income that's coming in. And net profit is your revenue minus your expenses. So I'll come talking about the expenses bit. They leave some vital expenses out of their calculation. So all they're focusing on is, I've sold the iPhone, I've gotten 1,002. Meanwhile, your actual profit is maybe 50 Ghana cedis.
Because of all the other things that took you to get there.
Exactly. Yeah. But for most businesses, all the focus is top line, revenue. For me, focus on your bottom line. And how do you focus on that? By reducing your expenses. If you're able to note whatever you spend to be able to sell that product, they know that this is my actual profit. How then do I make it better? Because if you only focus on the top line, it won't show you the actual picture.
That is also important because then it helps freelancers price their gigs.
Yeah.
Because then you can calculate the expenditure that went into whatever you are doing. Yes.
Yeah.
So that you know that, fine, to do this, I had to pay my internet bill.
Yes.
To do this, I had to move from the house
here
to the studio.
I spend on airtime.
I spent airtime calling.
People don't calculate that.
No, people don't calculate that. So that helps you in pricing.
Yeah.
Because sometimes you have to even chase an invoice after you send it, calling the person. So all that should go into your expenses.
And I mean, on your pricing too, again, that's another thing I always find it interesting in Ghana. We don't consider pricing modules. Like, what kind of pricing will suit my business? Am I looking at penetration pricing? What do I mean? Do I have to set my pricing low, enter the market, capture the market, then I'll start to increase my pricing? Or do I just do skimming price? What do I mean? Come high, people based on it. I mean, sometimes in Accra, it's funny. When people go to high, places that are expensive, they put this kind of, this place is quality.
Yeah, it's a premium.
Exactly.
They put on that.
So some people actually set prices high, then later they reduce it. And some people also use what you call value-based. And that's what's happening most in Accra. People say, this place now, malt is 4 Ghana cedis. For some places, they sell it for 20 Ghana cedis because of the perceived value that they feel that they can have on that particular place. So as a business, it's very important to know what kind of pricing module works for you.
Yeah.
Because something like photography, but for some people, because of maybe the name, they can charge you $50,000 for photography.
Yeah.
But for the same photography, maybe the same quality, someone can charge you 10,000 Ghana cedis for it. But because of the value and the brand that is associated with it, some people will be comfortable paying 50 Ghana cedis. As an entrepreneur, if you don't know this, you might shortchange yourself.
How do you feel about time-based pricing?
It's tough. Mm-hmm. It's tough. But the thing is, for me, the most important thing is you being able to separate, know which of them is important for you. What kind of pricing model? Again, you can check the industry you're in. Is it the time-based that you're using? Is it value-based? Is it cost-plus that you're using? Whichever is there for you, I think that's the most important thing to note. Then you separate yourself. Then how can I make it better? Mm-hmm. And that's what, again, it's really important. Knowing what it is. Yeah.
Definitely. What are some other mistakes small business owners and entrepreneurs can avoid?
You see, I already talked about it initially about the focusing solely on revenue instead of the bottom line, and I also talked about the kind of pricing that you should know for yourself. Now, another thing is sometimes as small business we tend to diversify too early. What do I mean diversify too early? Becoming the jack of all trades. You are into let's say photography. Then all of a sudden you want to do maybe something totally unrelated. Sometimes synergies are good in that you can build from, let's say, point A. Maybe let me use an example. You are into farming. Mm-hmm. Now, you instead of just the farming, you can look at, let's say, marketing the goods. Now, processing it, because you're trying to build a synergy. You're trying to build a whole business out of the whole value chain. Let me put it that way. But sometimes, as a small business, you don't have to start diversifying too early or spreading eggs in different baskets. Why? Each of the business has its own peculiar problems. If you're probably a one-man person or one-man show, and now you have to handle this, handle that, it becomes very difficult. But for me, what I always say is that if you're able to build your brand around a particular thing, then you begin to expand. Now, because of the initial brand and the value that your customers have for you, once you diversify, it becomes easier for you to bring people in. And maybe the final thing that people should look at again is the pricing bit. Price properly.
Whatever you do, I'm against time-based pricing. I'm biased.
Why?
I feel it's an inaccurate measure of your value as an individual or as a business owner.
Okay.
If your time-based pricing is basically, I'll do this for you because it took me X amount of time.
Yeah.
So X times the amount is your.
Again.
But then your accumulation of your experiences over time. So you can't really put that time in a number because you might have started something years earlier.
That's why we say that you need to know what kind of, for example, in the fashion industry, that is something that could probably work.
Yeah.
But again, you can do it better into value-based because someone can use the same 2 hours to sew this, but based on the value
and the experience they had or built up over time.
Exactly. So I'm saying that each of the pricing models are good for whatever purpose, but know the kind of industry you are in and what you want to make better.
Good.
Then you know that, okay, now this is where I want to get to, and this is how I plan on getting there. Pricing, it's so crucial.
So price properly.
Price properly, it's so crucial. And again, something I've mentioned already, start building your emergency fund. The pandemic has taught us one thing: nothing is certain, nothing is forever. Things can happen that can change the course of your business. So start thinking about putting something aside that if nothing is coming in, be able to still maintain your operating expense. Now, maybe most importantly, now the future is digital. How do you make your business a platform business? How do you make it accessible to many people at the same time?
And to add to that, how do you make payments seamless?
Seamless.
So it doesn't feel like paying you is a hustle.
Options.
Or becomes a burden.
Options.
Provide options.
Exactly.
Electronic payments.
Cash, you want cash, you want to take a check. But again, you need to know what kind of business, the kind of
industry
you are in.
Yes.
So those are kind of the things that you need to do. And finally, probably monitor your books well. Again, separate your business from your personal bit and see how you go on from there. Yeah.
All right. Well, Desmond, thank you for coming.
Thank you for having me.
For dropping all the important gems. I think we need to have you back because financial literacy is a broad field. There's so many things we could touch on.
Yeah. I think it's important. We talk about financial literacy not just for entrepreneurs but for everybody. I think for me it's supposed to be a must taught in schools.
Yeah.
From JHS, day one, start thinking about financial literacy. Yeah. Thank you again for having me.